Now for something completely different.
Forget everything you've been told by others before.
Who wants bonds? Bonds aren't doing anything, just sitting there paying an interest income stream. Who wants that nonsense?
Get ready for the real deal.
Speedos and estate
Never
plans.
skimp on a Speedo.
The full story. The whole enchilada.
I need all equity risk, so your psychology overrides your logicality. Is that actually a word? It is now.
It's money news and information you can use to grow financially healthy, wealthy, and wise.
Who eats beans and chili? You know who eats beans and chili? Yankees. Exactly.
Now, welcome in The Real Deal, the real investment show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. It's last week of February as we get ready to wrap up one of the weakest months of the year. Thank goodness it's been a bit of a challenge this month for the markets, just kind of trading sideways, but lots of news over the weekend to kind of get into. Brent may not be aware of this, but Canada, now the 51st state. Did you hear that happen over the weekend? Well, yeah. Trump didn't do it, but apparently, the U.S. men and women's hockey team now owns Canada. So anyway, congratulations to them. They took gold in the games over the weekend. So congratulations to the hockey teams. But real news over the weekend, of course, started this on Friday. The Supreme Court basically struck down the tariffs under the IEEPA structure that President Trump had used to install all those tariffs back in last year. Of course, then over the weekend, immediately after that, so two things happened. So the Supreme Court says you can't do tariffs that way. But they didn't really mention anything about any type of refund of tariffs, so that's kind of all hanging out there. What do we do with the tariffs we've already collected? What happens with those? The companies that paid those, do they get a refund? We don't know, right? So there wasn't anything stated by the Supreme Court on that. But they just said that basically the way the tariffs were done, it bypassed exactly what we talked about here, is that it bypassed the congressional process that is set up by the Constitution because tariffs are a tax and those have to be passed through Congress. So immediately President Trump shifted and imposed a 10% tax initially, then increased that to 15%. Underneath the Section 122 of the Trade Act of 1974. This allows him to establish up to 15% tariffs for 150 days. So he's now done that over the weekend, and that puts us back to where we are today. And of course, the question is right now is what does this mean? It doesn't mean a whole lot. Things really haven't changed that much. Most of the tariffs that have already been structured, they're already in the system. Most of that tariff effect is behind us. And in fact, Goldman Sachs did some research and said that these tariffs under this new trade law, because it's now a blanket tariff, before we had tariffs that were kind of all over the place. Some people were at 25, some people were at 10. There was kind of this one-off trade deal that we were doing. And that had put the effective tariff rate at about 10%. Underneath this new structure, that will lower the tariff rate to about 9%, according to Goldman Sachs. So again, this does not make a significant difference to the markets, and of course, the markets have already processed through most of this over the weekend. Bonds are trading pretty much flat this morning. Not a big deal on the future side, at least at this early stage. Stocks are down just a little bit, but again, we're also wrapping up a kind of a weak month of the year. So the markets had a nice rally on Friday. So again, just giving up a little bit of that gain from Friday. So really a little bit of knockoff from tariffs, but nothing dramatic. There was a lot of concern over the weekend that this was going to cause a huge market reaction. And really the market reaction is very muted and really pretty much aligns with what Goldman Sachs said. This is really a non-event of really this impact. So the question now becomes, of course, is what does the administration do next? Because he's going to have to reinstate these tariffs every 150 days. So at some point in here, we've got to go back to the legislative process. And if you're going to have tariffs, you need to pass that through Congress through legal means and basically set up the tariffs correctly as they should have been done originally. But again, this is the problem with executive orders, is that they bypass the constitutional process and they're subject to these types of rulings. And this is what happened over the weekend. And again, not surprising. We discussed that before, that this was probably going to be a bit of a problem because of the way it was structured and the way it was done. that it was going to probably run into some legal challenges. Of course, there's already, by the way, hundreds of lawsuits that were kind of sitting on the sideline waiting for this ruling to occur. So we're going to see lots of lawsuits come over the tariffs and over this new implication of tariffs. So again, that's going to kind of keep some of the stuff up in limbo for a while. But anyway, we'll keep you up to date as things kind of go along. We'll just kind of keep up, kind of keep this in view. But again, the market's already looking past most of this and have just already kind of factored in. And so again, not too much of a concern there. Outside of that, GDP came in on Friday as well, Thursday, Friday as well. That GDP report was much weaker than expected. That came in at about 1.4%. Everybody was like expecting 3%. That's a one-off effect. That GDP report was actually pretty decent. When you get below the headlines, personal consumption was decent. About 1.58% of the GDP report was that. The drag really came from net exports and, of course, the government shutdown. That government shutdown was one of the longest we've had in history. That shaved off a good chunk of that GDP report, which means that now that the government is back open, that Q1, we're going to probably see about 3.2% growth. You get that pickup now. So you're going to get a reversal in that data in the first quarter. So again, that's going to kind of wash itself out. But again, if you take a look at personal consumption expenditures, they were okay. They weren't fantastic, but they were good enough right now for kind of just a stagnant economy that we've kind of seen lately. We're continuing to grow at about that 2% clip-ish, overall. That's probably going to be the case this year as well. We're kind of just getting back to the normality of how the economy is actually running. The big concern points from that was that personal income continues to decline. Real personal incomes continue to decline, and the savings rate is dropping pretty quickly. So those are when you look at that report, the overall report was okay, but once you get underneath that surface, kind of into the engine of the economy, which is the consumer, watching that personal consumption, the personal consumption numbers run with a lag. And one of the kind of conversation points was that PCE ticked up. That runs with a fairly decent lag. CPI is already suggesting that that's going to show a decline in the next next 2 quarters. So PCE was a little bit hot, and everybody kind of hit the headlines, but that's going to, again, that runs with a lag. That's going to catch up to CPI in the next quarter or two. So not a lot of concern there. The big concern, though, was really the savings rate and the real personal incomes, which are showing some real signs of strain, and that's going to feed into potentially slower economic growth numbers in the next couple of quarters. So we're going to kind of keep watching that fairly closely. We need to see that to start to improve if we're going to see stronger economic growth. And again, as we talked about previously, earnings estimates for companies are very, very elevated. We're now starting to see those estimates come down already for Q1, and that is going to be those earnings estimates where they are going to remain problematic if we continue to see weakness kind of on that real personal income and savings rate side of the GDP, because that's where the money's coming from to fuel those earnings. And if consumers start to run out of capital, consumption is going to have to slow down. So really watching that personal consumption structure of the overall economy is going to be very important. Okay, so with that behind us, let's talk a little bit about the markets. Here's what you need to know before the bell. On Friday, actually last week, markets came down, had touched that 100-day moving average. We worked all through that last week, closed right at the 20-day moving average, just slightly above it on Friday. So again, kind of a decent recovery, but again, just going nowhere at this point. The market's just continuing to kind of internally rotate. Friday was a good day for the mega caps. We saw some selling in energy and other areas. This morning, it's just the opposite. Healthcare is going to be doing well today. Eli Lilly's up pretty sharply this morning pre-market. Everything else is kind of flattish a little bit. Nothing really overly dramatic. But again, just continuing to be stuck in this range. February did live up to its name of being one of the weaker return months of the year. The market's really not done a whole lot for the month. In fact, for so far year to date, the S&P's up about 1.2%. Internal sectors, though, again, we talked about this last Monday, is got a big bifurcation. You've got really big gains in areas like energy, base materials, and industrials. And then on the flip side of that, you get into technology and finance and healthcare. And those have been pretty weak. They've got positive returns for the year, but they're fairly weak. So again, just looking at this kind of divergence in the overall market suggests that there's some real risk here. In fact, taking, as we had showed you previously, when you take a look at the performance between the S&P 500 and the equal weight index, we've got this outperformance of this equal weight index over the S&P. Now, this is important because this is where your breadth is coming from. Once you start talking about the equal weight index, that's where we kind of weight everything fairly equally. This is your outperformance here. The breadth right now in the S&P 500, 65% of constituents are outperforming the index this year. That's the highest level in 50 years. Now, again, nothing wrong with that except for the fact that when you have these very high levels of percentages of stocks all outperforming the index, that's typically where you start getting a reversal in that performance. So whenever somebody says something, it's like, oh, it's the highest level in 50 years, that means that previous records of over the last 50 years were where that breadth faltered. Right? So whenever you hear, records are records for reasons, because that was the peak level of some activity of what was ever going on, and that suggests that you're going to start getting a reversal in that breadth. So again, this has been a very, very big outperformance by equal weights. Doesn't mean that's tomorrow, next week, but just understand that when you have very high levels of outperformance, that's bullish near term, but you're going to start seeing that reversal of that breadth. So again, we talked about these sector and market rotations. We're getting very much set up for that type of rotation in the market. So again, just don't forget, rebalance your risk, take profits, do those type of things. You're going to get this rotation at some point, so just be aware of that. All right, that's what you need to know before the bell this morning. We're going to come back. Got to talk about a couple of things. We're going to talk about the 10 laws of money, and is China actually selling treasuries? We'll get into all that. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning. Welcome to the show. So let's start with, so I'm going to spend some time next week with John Penn discussing the 10 laws of money. John's got some stuff he wants to go through tomorrow, so I'm going to push this off for a week. But next Tuesday, John Penn and I will kind of go through the 10 laws of money. But importantly, this is something that we've spoken about for a while, and finally I sat down and I created an ebook to help and this is something, as we've been talking about on Two Dads on Money for a while, is just kind of these different aspects of things that we deal with our kids. And so I went ahead and sat down, and over the weekend, over the last couple of weeks, I wrote an ebook for my kids. And this was kind of the culmination of a lot of these conversations. But and Brent, can you show our website right here? If you go to our website, go to the resources tab at the top, we have what's called the eGuide library under the resources tab. And if you go to this resources tab, you'll see a whole list of ebooks that we've written, from real investment advice, how to manage your portfolios, to trading guides on investment rules, Social Security maximization. There's a lot of stuff, a lot of ebooks that we've written on this page. But right at the top left-hand corner is the ebook that you can download for the laws of money and wealth, and send it to your kids. This is just those tidbits of kind of knowledge of, how to budget, looking, how to build a 50-30-20 budget, why you should stay out of credit card debt, how to get out of credit card debt. We talk about the snowball solution. It goes through a lot of these different aspects of
really what it takes. Investing is fine, but it's hard to invest if you don't have money to invest. You need free cash flow. And so what this goes through is getting out of debt, things to do to get yourself in a better position, how to budget, and then how to invest and how to become that millionaire next door that we've talked about previously. But anyway, that guide's on the website. And John Penn and I will spend a lot of time, like I said, not tomorrow, but next Tuesday, we'll go through this in a lot more detail and just touch on it. But I just wanted that just to let you know that that's there for you. And I highly encourage you. It's an ebook, so it's a nice PDF format. You can save it, download it, print it out, give it to your kids, however you want to do it. But again, I think it's a good, I think anyway, my kids will probably just roll their eyes at you and just, say, yeah, whatever. But I think it's a good starter process to kind of start getting some of these financial lessons out there that you can sit down and talk to your kids about and make sure they're kind of moving in the right direction. Because there's so many myths out there. It's like, oh, you've got to have a credit card to build credit. No, you don't. That's hogwash. But, it's so easy to get in that trap of credit card debt that you just don't realize that you're doing it at the time. And so this just kind of goes through a lot of, it's not real long. It's about 10 pages altogether, but it's there for you. Anyway, so let's have a quick question for the chat this morning. How many of y'all believe that China is selling U.S. Treasury bonds? Just give me a yes or no in the chat real quick. Because I just like that, because this has been a common narrative that's been running around the markets for a while. And it's always interesting because you see this chart like this that shows, this decline of China's share of U.S. Treasuries. And everybody immediately, the persistent purveyors of doom are out there going, see, they're selling our treasuries. They don't want anything to do with U.S. Treasuries. And this means that interest rates are going to go up, and the U.S. can't sell their treasury to anybody. So I'm just curious how many of y'all in the chat actually believe that China is selling U.S. Treasuries because they don't want to be in the U.S. dollar anymore. They're de-dollarizing. So I got a lot of no's. I'm surprised. I thought y'all would mostly be. That's considering how bearish most of you guys are. I'm kind of surprised that y'all aren't saying a lot more yeses. Anyway, well, maybe I have a smarter audience than I thought. No pun intended. So let's talk a little bit about what's actually going on. So there's a problem with the narrative, which is that, yes, when you look at China's holdings, net holdings, they are declining. I just showed you the chart of that. So that chart is an accurate chart, and that's the way it's calculated. Now, let me explain something real quick. I used to spend several years of my life before the turn of the century, that makes you sound old, working overseas. And I worked overseas, and I helped manage money for high net worth investors that lived in France. And we worked through several other countries at the time that were offshore to France, right? Because so France has about an 80% tax rate. So if you make money and bring it into France, you're going to get taxed about 80%. By the time you pay your income tax, your value-added tax, et cetera, it's about 80%. So smart investors don't want to bring their capital back into France once they make money. And so we were working through countries like Luxembourg and Andorra, which is this little country on the border between Spain and France that's basically kind of a private banking community. But we worked through Luxembourg, we worked through Belgium, we worked through the U.S. because the U.S. is offshore to France, right? It's another country. Now, if I have assets, now this is where this is really important. Let's say I've got some securities. And if I deposit them in a bank in France or a broker's firm in France, what have I done? I have domiciled those assets into the country where I pay tax. Okay? So if I want to avoid that, I have to do what? I have to domicile those assets somewhere else that is not inside of France. I have to have the custodial relationship with somebody outside of the country I'm trying to avoid paying tax in. And that's why you use other countries like Andorra or Luxembourg or Belgium or Switzerland. You've heard about all the numbered accounts in Switzerland. Everybody's heard that. But that's what you're doing. You're domiciling your assets outside of your country of taxation or law or whatever it is. Now, for China, this is exactly what's going on. When Russia invaded Ukraine, the U.S. immediately started applying sanctions on Russia, started seizing assets. You know, you heard the stories about the yachts that were sitting out there, and we go seize the yachts that belong to these Russian oligarchs, et cetera. And so China said, hey, we don't want that happening to us. So we need to change the custodial relationship of the assets of our reserve currency. And we've talked about reserve currencies here on the show before. China has to maintain a reserve currency basis with the U.S. because they trade with the U.S. and the world trades in dollars. But it doesn't mean I have to maintain my custodial relationship in the U.S. And so China said, hey, there's risk of all those treasuries, those $1.1 trillion worth of treasuries we own that are custodied inside of the U.S., there is a risk. We just watched them do this to Russia. If we leave those treasuries there and all of a sudden President Trump gets pissed off at us, he could go seize all of our treasuries and our reserve assets sitting in the custodial relationships in the U.S. We need to move those somewhere else. And this is important because this is even in the Treasury's own FAQ. If the Treasury security, this is a quote, if a Treasury security purchased by a foreign resident is held in a custodial account in a third country, the true country of ownership will not be reflected. So this is why Belgium and Luxembourg are very, very important to this whole equation. And this is the part that most of these narrative generators out there that are looking for clicks or views or headlines or whatever, saying China's selling all of our assets, the U.S. treasuries are getting out of the dollar. No, they have shifted their custodial relationship to Luxembourg and Germany. Here's a chart of foreign holdings of U.S. treasuries, billions of dollars by China. And this is from the Treasury International Capital data, the TIC data. So China has about 600, no, this is as of November 2025. So it's a couple of months old, but you get the idea. About 682 billion of treasuries in the U.S. is held by China. China then owns about 481 billion in Belgium and another 425 billion in Luxembourg. Now, now, if you say, well, how do you know that's China? Well, Belgium and Luxembourg have no business holding basically almost $1 trillion worth of treasury bonds for countries their size. They don't need that type of reserve currency balance. And if you've ever been to Luxembourg, you will notice one thing. Now, this is also funny because people that have never worked in another country or never traveled to another country don't really understand what's going on. Go to Luxembourg and see how many Chinese banks are in Luxembourg. It's like freaking McDonald's. But anyway, so here's a chart. This is China's U.S. bond holdings falling, right? So the black line you'll see in this chart, this is the headline number, right? China's selling all of their bonds. That yellow line at the bottom, that's Belgium. Do you notice the almost perfect inverse correlation between Belgium and China? That's that shift of that custodial relationship. So for as much as China's bond holdings in the U.S. has fallen, the custodial relationship has changed. You've seen an increase on almost an exact basis in Belgium. Throw in Luxembourg and you're going to get there. So if you actually, here's the chart. This was from Daily Shot the other day. I want you to take a real close look at this chart. There's a lot going on, but this is very important to this whole narrative of de-dollarization everybody's getting out of the US dollar. Nobody wants to own US dollars, etc. You will notice that every country, with the exception of just China's U.S. custodial relationship, you can see that yellow line in the background. That's China's U.S. custodial relationship Treasury bonds is falling. Everybody else is rising. In particular, Belgium and Luxembourg. UK has a very sharp increase in U.S. Treasury bonds. Japan, etc. Now, you'll notice that kind of dashed line in the background. That's Chinese holdings, including Luxembourg and Belgium. And you'll notice that they're about the same as they were in 2011. So they haven't really changed a whole lot. They go up and down like everybody's does, because again, countries are adjusting their treasury holdings to maintain. This is a very important part of this conversation. And again, take some time today, particularly if you're in the camp that believes that China is selling our bonds. Take some time and read this article. It's on the website this morning, right? I go through all of the risk, why this is going on and what's happening. This isn't conspiracy theory. This is just financial plumbing and the way the world works. One of the primary reasons that China uses Belgium for custodial purposes, besides avoiding geopolitical risk, is that the Euroclear bank system is in Belgium. Clearstream's international depository is in Luxembourg. So when a central bank or a state institution wants to hold a large treasury portfolio with flexible settlement, collateral options, etc., those hubs help address that because I've got immediacy at that point. Brad Setzer over at the Council of Foreign Relations has repeatedly made the point that the reported data understates China's dollar bond exposure due to offshore custodians and portfolio shifts across dollar instruments. In his words, he said China isn't shifting away from the dollar or dollar-denominated bonds. They're just shifting the custodial relationship. Now, the reason for all this, again, geopolitical risk management is a huge key for that. And it became an issue for China when we started sanctioning and seizing assets of Russia following the Russian invasion. That's when they really woke up and said, oh, I got to change where I'm keeping my custody. But there's also settlement efficiency and scale in this. And you have collateral mobility, financial liquidity, financial optionality, data, optics, and portfolio composition. These are all important aspects to maintaining a currency reserve. Now, so all of this is extremely important because what people misunderstand when they look at the data and they say, oh, China's selling our treasury bonds, you have to look at how the financial plumbing works. All these countries, when we get down into the very base of all this, all those countries, on the chart I showed you, everybody's increasing their reserves to the U.S. Treasuries. You have to maintain your currency reserve in U.S. dollars. And how do I do that? I have to buy dollar-denominated assets. I can buy the dollar, right? So I could literally just convert Chinese renminbi, whatever, into U.S. dollars and stick them in the bank. But that gives me no return. So all I'm doing right now is getting currency risk between one currency going up and another currency going down. So if I have a dollar in the U.S. dollar and a dollar renminbi and the dollar gets weak relative to my currency, then I lose value in that currency. So I can hold dollars and foreign central banks do own actual just dollars. They do have that for liquidity and trade, et cetera. But mostly they hold the reserves in either gold or treasury bonds or U.S. equities. They need something that trades in dollars. So gold trades in dollars everywhere in the world. If you've ever wondered why London spot is priced in dollars rather than the British pound, it's because gold trades in dollars everywhere in the world. It's a dollar-denominated trade. The U.S. Treasury bonds trade in dollars, obviously everywhere in the world. So as a country where I need to balance my currency to the U.S. dollar for trade, I need to hold reserves. to balance that. And that's why you see the reserve balances or treasury balances go up and down. That's the adjustment for the yuan getting stronger than the dollar or the yuan getting weaker than the dollar. And they're adjusting those reserve balances to try to keep that peg. The peg's never perfect. It's never a zero, right? It's never 100 on 100, right? It's always a little higher. It's always a little lower, those type of things. But overall, the goal is to try to keep the dollar on a peg basis. In other words, the dollar needs to trade, as an example, if you look at the US dollar right now, it's trading slightly below 100. The 100 is the peg to the basket of currencies. And the dollar sometimes trades very close to 100, sometimes it trades lower than 100, sometimes it trades higher than 100, but it just goes back and forth over time. And when the dollar gets too strong relative to other countries, that impacts trade to those other countries. If things are more expensive to other countries, that makes trade that's an additional inflation, as an example, on them wanting to buy our exports. When our dollar's too weak, that makes their exports too expensive for U.S. citizens. So it's inflation here. So the goal for all these countries is to try to keep their currency somewhat close to the peg so that you don't have that inflation adjustment due to currency differentials, right? So that's why it's so important that these countries own U.S. treasuries. And this whole kind of thesis is just misguided. It's mostly put out there by people that don't understand the financial plumbing and how things work and why it's so important to own U.S. treasury bonds, why that's not changing, why 88 to 89% of all FX reserves transactions occur in dollars. It's because of this trade need that we have on a global basis. Now, one thing people say, well, yeah, but the percentage of foreign transactions in U.S. dollars has declined somewhat over the last 20 years. Yes, that's true, because 20 years ago or 30 years ago, there was no such thing called the euro, right? And so the euro has come in, and since we now have the euro and countries in the Eurozone can trade with each other in the same currency, that's taken some percentage of foreign transactions, and you would expect that. So the number of transactions that occur in the Eurozone in dollars has declined, and the euro has gained some traction. But it's still predominantly transactions around the globe are done in the U.S. dollars, and that really hasn't changed that much. So again, when we take a look at all these, as the bottom line of this is this. How should you, as investors, look at U.S. Treasuries, given all this kind of data narrative that's running out there, right? And this is the challenge. We have all these really negative headlines that are coming in from sources, right, that you watch, pay attention to. It's like, oh my gosh, did you see the latest data? This is happening, dollar debasement, whatever. This is why it's important to kind of get back to understanding the financial plumbing, how things work, and what this means for you. So how do you as an investor look at this? And so investors should treat treasuries as a tool, not a referendum on geopolitics. And this is the mistake that a lot of people make. And look, the headlines are great. It gets clicks and views. If I was going to do a show this morning and said, China's dumping all of our treasuries, right? We would have 2,000 people tuned in wanting to know, why the end of the world is coming. It's just that's what sells, right? Fear sells. But it's critical to your portfolio outcome to understand the entire context of global markets and U.S. treasuries in particular. U.S. treasuries are an anchor, or I should say U.S. treasuries anchor risk-free pricing globally. Treasuries are considered a risk-free asset. They're the largest, most liquid, most safe market in the world. They sit at the core of repo and collateral systems globally, and they serve as settlement assets during stress. So whenever there's a period of financial stress, everybody goes back to treasuries to settle. Why? Because it's liquid, it's safe, it's deep. I don't have to worry about, quantity or size. If I need to move billions of dollars at a time, I can do that in U.S. treasuries. I can't do that in Brazilian real. There's just not enough of them there. So this becomes very important. So secondly, focus on the real drivers of Treasury returns, which is GDP and inflation. And there's a very high correlation historically. Brent, show this chart for me. This is a correlation chart of a composite index of GDP and inflation versus rates. There's an 84% correlation between those. In other words, the high correlation suggests that the thing you pay attention to is GDP growth and inflation, as we've talked about before on the show. That tells you about where interest rates should trade. So right now, inflation's running about 2.4%. GDP is growing at about 2% on average. So you get about 4.25, which is about where we're trading right now. Now you can get a little bit of a premium now, and that's called term premium. That's just, kind of a risk number that is assigned to the markets by traders. It's a premium to the actual underlying fundamentals. It's like, hey, I'd like a little bit more based on what's going on. So you have a term premium on top of that. But basically, over time, as this chart shows you, is that interest rates trade very close to GDP and inflation. So if you really want to know where interest rates should be trading, GDP and inflation. It'll get you pretty close to the mark most of the time. But as an investor, you need to build your Treasury bond portfolio and look at the investment exposure based on objectives rather than narratives, right? So if you need liquidity and drawdown control, focus the majority of your bond portfolio to short to intermediate duration treasuries. That's going to give you very little volatility risk. If the market draws down, it's going to protect you. It'll actually benefit in that part, because if the markets are really drawing down, the Fed's going to start cutting rates, and the short end of the curve is going to get impacted by the Fed cutting rates and protect you in that front. If you need income and controlled volatility, well, that's where you start kind of laddering things out between the front and the intermediate curve and start adding a little bit of longer duration. If you need to adjust for inflation uncertainty, you can add some tips. But think about your portfolio as a toolbox rather than a narrative guide, right? The narratives are fine. But when you own treasuries, you own them for reasons. And so what are the reasons that you want to own treasury bonds? Look, if you have no concern about risk, right, and you're just in this to make as much money as possible investing, you shouldn't own treasuries. You should just be 100% long stocks, right? But if you start getting to the point where you need lower volatility, you need income to your portfolio, you need stability, you need guarantees that principal will be there at some point in the future, that's where you want to start adding treasury bonds to your mix. So think about your portfolio in that vein rather than worrying about some narrative. Especially when the narrative is as misguided as a lot of this narrative running around about China selling bonds. Again, it's just mostly a lack of understanding. And that's okay. That happens, right? These are big, broad narratives, and they are easy for people to grab onto without really understanding them. And I can throw up a chart real quick and say, look, there's the evidence right there. So, you just kind of miss the other components of it. And that's most of these narratives, like the dollar debasement narrative. We've been through that as well. That's another false narrative. But, as investors, we need to focus on the risks that matter, right? So duration risk matters. So if you're building a portfolio, again, you need short-term liquidity. Don't buy long duration bond. Don't buy a 10-year treasury bond if you need liquidity in 6 months or a year. So duration risk really matters. So you have to match your duration of the bonds you own to your actual financial goals. And everybody's different, right? I can buy a 10-year treasury in my portfolio and hold it because I have no need for the capital for the next 10 years. Brent may need his capital in 3 months or 6 months or 9 months. So he shouldn't be buying a 10-year bond if he needs his capital in 3 months. He needs to buy a 3-month treasury. So the duration is important. Inflation risk is important. If I'm concerned about inflation, I need to add some tips to the portfolio. But again, inflation and economic growth is what's going to drive my yields. So I need to have a good understanding of that inflation risk to understand what my yield structure should be and what I'm paying for today versus where I think inflation's heading to. So if you're in the camp that you think inflation's going to 10%, you definitely want to own some tips and hope you're right. If you're in the camp that inflation is going to return to 2%, tips may not be as good of an investment in that environment if you're right. See, so some of this risk analysis comes down to your beliefs and your planning. So this is why it's important to really have a good firm handle on inflation trends, inflation expectations. Pay attention to that data because that data kind of tells you what the market as a whole thinks. So really, and this is important because we all have our personal biases. The market, there are tools out there pricing. Everybody that's trading in this market, stocks, bonds, whatever, those are millions of people all trading on the same set of data. Things like inflation expectations have a really good track record of telling you where inflation is going to be and whether it's going up or down. So if you're in the camp that you think inflation's taking off to the moon, go look at inflation expectations. Even during the spike in inflation that we had during 2023, 2024, where we went to 9% inflation, inflation expectations never rose that much. The market knew that inflation spike was temporary because of all of the liquidity injected into the system and the shutdown of the economy. And they knew and inflation expectations were telling you that was going to return back to where it is. Now inflation and inflation expectations are roughly in line with each other again. There was a big gap. Now they've lined back up. So pay attention to inflation expectations. Very important to all of this. And of course, policy risk. That's a big deal, right? So just over the weekend, we had this whole tariff issue. That's a policy risk. If that causes a big shift, right, that could change the dynamics of yields to some degree, right? That should be expected. But what's the long-term policy risk, right? Tariffs will last as long as Trump's in office unless he passes them through Congress. As soon as the next, if a Democratic president or the midterm election is completed and Democrats take control of the House or the Senate, we elect a Democratic president at the end of Trump's term, he walks in and says, tariffs are over, done. We're going back to the way things were, they're done, right? So policy risk can be very short-lived. And so you have to account for those issues as well. One of the mistakes that we make as investors is we extrapolate a current event into an indefinite future. We say inflation's going to go up forever, right? Energy stocks are going to go up forever. Oil prices are going to go to 600 and just keep going up forever. Those things, nothing ever lasts forever. So it's important is when you're building your portfolio to build your structure with the dynamics that we have in hand today, but be flexible to change that duration and structure, particularly in your Treasury bond portfolio as an example. Be flexible. We shift in our 60-40 allocation. We're constantly shifting that duration within our portfolio as things changes. We were longer duration we had mostly long duration bonds back in 2020 when rates were falling. We have very little long duration today. We have mostly short duration, just a smidge of kind of the short to intermediate length bonds, right? So we shift the duration in our portfolio as the environment changes, and that's important to how you look at your portfolio too. One of the mistakes that I frequently see with investors is they're just buying long duration bonds because that's all they've ever heard about. They just hear about the 10-year Treasury, so I got to buy that because that's what I heard about. There's all different varieties. There's 1 year, there's 3 years, 5 years, 7 years, 10 years, 20 years. I mean, there's all different types of flavors of bonds, structures of bonds, etc. So you don't have to be stuck with one thing. You can adjust your bond, just like you adjust your stock portfolio, you can adjust your bond portfolio just as well. So again, just paying attention. Anyway, all on the website. So go to the website, download the article today. It's called Is China Dumping U.S. Treasuries? But I go through all the plumbing structure in a lot more detail Didn't want to bore you with it this morning. Probably bored you enough already with it, but that's all on the website right now. So again, you can kind of go through that and get a better understanding of why China is doing the things they're doing and why it makes sense that they're doing the things they're doing. But what's important is that they still own over $1 trillion worth of treasuries. They just own them in a different place. That's all. All right. Thanks for joining the show this morning. We'll be back tomorrow with John Penn for Two Deads on Money. And then next Tuesday, we'll get into the 10 laws of wealth and money. So if you missed the first part of the show this morning, go to the website, go to our resources tab on the website, go to the ebook library, and I just published an article that it's an ebook on the 10 laws of wealth and money. So if you're joined late this morning and missed our conversation early, go download that guide, send it to your kids. It's a great way to get them started on the right path to paying off credit card debt, staying out of debt, driving, what kind of car to buy, all that stuff is in there. It's all in the e-guide on the website now. And of course, we'll see you back here tomorrow morning for the next edition of the Real Investment Show with John Penn, Two Dads on Money. Y'all have a great day.